Hello, and welcome to the Get to Know Hedge Fund Investing series with Carl, the Carl Investment Platform. I'm Jamie Eppenberg, and we have been looking at the individual investment strategies on the Carl platform today. We looked at Kilimanjaro, which is commodities, great diversifier. We looked at K2, very strong profile, both on the gain side and risk side with K2, while you have to decide where you are with it today. We now are going to Olympus, which is quite different than what we've been looking at. Been looking at long onlys, and with Olympus you're looking at a true tail hedger. This is all it does. It's every day, every moment. The Olympus strategy is looking for the down market and its moment to shine. Now let's just talk about tail hedge for a minute. What that means, if something is a true tail hedger, it does not have a strategic investment plan, opportunity. It's not going to invest in a flat or bull market. If it determines the market it's not going down, if it's flat or growing, you're not going to see movement in Olympus. So this is a tail hedger, and the strategy manager here is Dr. Ernest Chan, Ernie. He will tell you that there is an insurance cost to a true tail hedger. I will mention that Olympus is an award-winning tail hedge, many award. They win an award every year. The strategy that the Carl Olympus is based on, because the Carl Olympus has been running about a year. The strategy that it's based on has been running over 10 years, and it has caught, I won't say all overall, but all of the major market downturns within that period. And that tends to be why Ernie, Olympus wins. The Olympus that the Carl is based on has won the awards that it has. It historically has detected these down markets and then performed. You'll see this if you go on the mobile app and you look at February and March of 2020 or a period around that time, you will see that I'm looking at a 4-year plus year to date, right? And it's pretty mellow. And then at that 2020, it goes up significantly. And that's its job. During those other periods where it just hangs around the market, it has what's called an insurance cost. And Ernie will be, the first one to tell you there's an insurance cost to a true tail hedger. It's going to have very small losses during those flat and bull periods. And obviously you're going to have some fees with that. They very much make it their goal to make sure they minimize those losses as much as possible. And they actually put in new systems to protect that capital in growing or flat markets. It was November, December of 2019. And they were very pleased that, with those new mitigations, they still caught what happened in February and March of 2020. So they're looking to protect capital while you will have an insurance cost. Because of that, we often see investors in a true tail hedger keeping the investment somewhere in the 10 to 20% range, depending on their portfolio, because it is like having insurance in your portfolio. Statistically, also a tail hedger in white papers, if you were to read up on them, they do lift a portfolio overall. So it's an interesting decision. Do you keep a true tail hedge as an insurance in your portfolio? Statistically, it says that it can lift a portfolio overall because you're going to have more capital working when the rest of your portfolio is down. While, these are decisions you have to make for your own portfolio. Do you take a hedge that still works in a flat and bull market, still has some growth in a flat and bull market? And we'll talk about that in another investment, or go for true tail hedge insurance. So a lot of decisions when you're looking at tail hedgers. We start with this one, and in the next session, we'll look at one that does still have some growth, but it has a hedge built in as well. And you'll be able to make the decision that's right for you. All right. See you next time.